In this video, I'll be breaking down exactly how someone who is 55 years old with $3 million in savings should be thinking about taxes and why the next 10 years are the most important window you have to keep more of what you've already earned. Through working with high net worth families in this exact situation, I've discovered that most people at 55 with $3 million saved are sitting on a tax bill they don't even know is coming, and their current advisor has never run the numbers on it. That's exactly why I'm making this video today, to show you the specific strategies that actually move the needle this stage of life, and the mistakes that quietly cost people 6 and 7 figures over the course of retirement. Let's get right into it. If you're nearing retirement with over $3 million saved, this is one of the most important tax planning moments of your life. At this point, you have assets, income, and time to make impactful and strategic tax moves before retirement. Planning ahead is key. Don't wait until Social Security and RMDs have already started. $3 million is a threshold where cookie cutter advice and rules of thumb don't have the same impact as personalized planning. What got you here won't get you there. When you have $3 million saved and don't do proactive tax planning, you end up getting crushed by taxes on RMDs and leaving your kids with an enormous tax bill. What happens to most people in retirement is Social Security and RMDs cause income to increase, introducing Medicare surcharges. Families who don't plan for this often end up paying hundreds of thousands in unnecessary taxes. The goal of tax planning is for you and your family to pay the least amount of taxes over your lifetime. Focus on lifetime tax bill, not year by year. So the first thing to understand is that retiring with $3 million is not a finish line. You have about 10 years to make moves before RMDs kick in. Now is the time to set yourself up to minimize your tax bill. Now, let's get into exactly what that looks like. Where your $3 million is sitting matters more than what it's invested in. Money in a 401k or IRA is treated much differently than money in a Roth IRA or a non-qualified account. Tax-deferred accounts like 401ks or IRAs are partnerships with the government. This money isn't all yours, and the more you have in these accounts, the more the government takes, and the less you get. How you're saving across these account types goes a long way in determining how much you can actually spend in retirement. Someone with $3 million in a 401k will have much less spending power than someone with $1 million in a 401k, $1 million in a Roth, and $1 million in a non-qualified account. This is why Roth conversions are the single most powerful move in the window between retirement and RMDs. A Roth conversion is when you move money from a pre-tax account into a Roth IRA, paying the taxes now and never paying taxes again. There are no income limits to conversions, and you can convert any amount. Years after retirement and before RMDs start can be some of the lowest income years you have remaining. Strategic Roth conversions, the right years and the right amounts, can save you 6 figures in lifetime taxes. Most advisors never address this and don't model a client's full retirement picture. If you want help building a complete tax strategy for your situation, visit our website where me and my team can walk you through exactly how to keep more of what you've already earned. We can't work with everyone, but we'd be happy to take your call. What is asset location, and why does it matter more than asset allocation at $3 million? Asset location is placing the right types of investments in the right account types to minimize taxes. Tax inefficient investments like bonds or higher turnover funds should be in tax deferred accounts where tax inefficiency doesn't matter. Tax efficient investments like ETFs should be in non-qualified accounts because ETFs have very little tax drag. Most advisors have all accounts invested the exact same way. You have to balance tax efficiency with your distribution strategy. This is very nuanced and very important. Asset location is the kind of fix that costs nothing to implement, but most people never get because their advisor is not looking at all their accounts together. Now, let's talk about the strategy that becomes available if you have any kind of self-employment income. A solo 401k with mega backdoor Roth for self-employed income. A properly designed solo 401k allows you to contribute much more than a standard 401k or a SEP IRA. As long as you W-2 yourself at least $72,000 a year, you can contribute up to $72,000 a year with a mega backdoor Roth provision. This is an after-tax bucket over and above the regular employee deferral. You can then roll that contribution to your Roth IRA immediately. There are no income limits like a Roth IRA contribution and much higher contributions than a standard backdoor Roth. This allows you to get tens of thousands of dollars into a Roth IRA each year. This is one of the most underutilized tools in the tax code. If you're self-employed, this is so much more powerful than a SEP IRA. Who actually qualifies for this, and how do you set it up correctly? The key to a solo 401k is you have to have self-employment income, and the only employee you can have is your spouse. It is critical that the plan be set up correctly. Schwab, Fidelity, and Vanguard standard solo 401ks don't have the mega backdoor Roth provision. Your plan administrator needs to coordinate with your advisor and CPA. This is the type of strategy that's missed when your CPA and your advisor don't communicate or work together. Now that you understand the strategies that can move the needle at this stage of life, let's look at what you actually need to do next so you can apply this to your own situation. Nearing retirement with $3 million, the starting point is a full inventory of all your investment account types. You need to be reviewing your tax return every single year. If your advisor is never asked to see your tax return or just says talk to your CPA, those are the clearest signs they can't help you with what comes next. Real integrated tax strategy starts with a multi-year projection that maps out Roth conversions, asset location, and solo 401k contributions year by year. It includes coordination with your CPA on the actual filing decisions and quarterly estimated payments. This gets reviewed and adjusted every year based on your income, tax law changes, and market performance. This is the difference between a generic plan and an engineered tax strategy. Now that you've seen why 55 with $3 million is the most important tax planning window of your life, and specific strategies that actually move the needle at this stage, you can stop guessing about your retirement tax bill and start engineering the outcome you want. If you want help building a complete tax strategy for your situation, visit our website using the link in the description, where me and my team can walk you through exactly how to keep more of what you've already earned. And I'll see you in the next video.